Hello, everyone. Welcome to our, what month are we? November. Oh my goodness. How is it November already? I don't know how that happened. Welcome to our November membership workshop. Super excited for this one. It's about one of the topics that I get asked about all the time. Hey, Mackenzie. And I can see Mackenzie's name, but there's somebody else here. I can't see. Whoever said hi. Oh, Monica. Hey, Monica. For folks who are here, if let's see, above my name, there should be something that says, "Hey, I'm going live using StreamYard. Please click this link." Clicking that link allows me to see your name. Hey, Anne on YouTube. Awesome. Okay, we've got our incredible members here. So this workshop today, and I call this one a workshop, but it's a little unfair because we're not really going to do any work. I'm mostly going to talk for an hour, which I hate to do. But when it comes to this topic, there's just so much information that it's just kind of how we got to do it. So today's topic is the best retirement options as business owners. And I'm going to just full disclosure. Let me get my slides going on over here. Full disclosure, this workshop is going to make your head hurt. And I'm sorry for that. There is no way. I've tried a million different options. There is no way to make this topic super easy. It's just not. The retirement options are vast. So Mackenzie says, my kind of workshop, no work for me. Love it. I think this is Monica saying you're back at home. It looks like, yes, Monica, I am. Thank you for asking. Finally have power back. I'm good to go. We're in good shape. But yeah, this workshop just has a lot of detail. It's going to make your head hurt a little bit. You're also probably going to walk away from this and say, I'm still not sure exactly what I should do. And that's normal and that's okay. What I would recommend, a couple of things. Number one, if you have an accountant, which some of you here do, definitely talk to that person. We can go, if it's me or your accountant, we can go further in depth and really look at your specific situation. The other thing I would say, if you don't have an accountant or a tax preparer, is to just rewatch this. Save this as a resource. It's always available in your member portal. Save it as a resource and come back to it, especially as your business changes. Because some of the things we're going to talk about today, I'm going to say this is good for you if you're here. This is good for you if you're here. So that'll change, of course, over time. But we've got a lot we got to get through. So let's go ahead and get started. And let me see if I can figure out how to actually use my slides. Okay. So there are three buckets of retirement options that exist and that we're going to look at today. They fall into these three buckets: employer sponsored, meaning your employer offers it as a retirement plan; individually established, meaning you, thanks, Mackenzie. Oh, goodness. Mackenzie's telling me my ticker at the bottom says I'll be live soon. You know what? That's about how today's going. Awesome. Thank you for that. Okay. So employer sponsored. Individually established, meaning you as an individual person go set it up. It's not connected to your employer. It's not connected to a business, nothing. It just lives on its own. And then the last one, self-employed. And those are specific options for self-employed folks or small business owners. So three buckets. And we are going to touch on all three today, because even if you are self-employed, even if you own your own business, the employer-sponsored might come into play. And we'll talk about that in a little bit. Let's see. Why can't I keep moving my thing? That's fine. Okay. So a couple of things I want you to keep in mind as we're talking through retirement options is that there are at least four. There's probably more than this, but there are at least four big factors that matter when thinking about what retirement plan makes the most sense for you. What type of business entity you have. This one doesn't matter as much as the others, but if you are like a C Corp or an S Corp versus just being a sole proprietor, it might change things a little bit. If you have employees, if you're going to have employees, how many employees, what type of employees, that definitely matters. What your income levels are. So your income today, where is your income today? And then also, where do you anticipate your income will be when you retire? That's going to come up as well when we talk about, do you want the tax benefits today or do you want them when you're retiring? And I know that's a hard one, by the way. People always say, well, I don't know what it's going to be like, but start to think it through, right? If you're going to pay off your house by the time you retire, if you are, if you're not going to have a lot of debts by the time you retire, if you're not going to have a lot of needs in terms of things you have to pay for, then you may not want to have a lot of retirement income, right? Like you may not need to be bringing in a lot of money. And so your income may actually be lower. On the flip side, if you're like, I'm going to keep my business and I'm going to keep working and I'm going to do all these things, or I've got a lot of investments, like I'm going to have lots of income, then that's something to be aware of as well. And then the other factor is whether or not you have access to other retirement plans. So if you have a spouse who has an employer-sponsored retirement plan, or if you have another retirement plan, maybe you have a W-2 job and you own a business. So maybe you're in your W-2 job, your employer offers you a plan. That can affect what options make the most sense for you. So just some things to keep in mind as we're talking through these options. I also want to mention, I'm going to go somewhat fast because we got a lot to cover and I want to make sure this doesn't take us 2 hours. So please let me know, put your questions in the chat. I'm watching it. If I don't answer it right away, I promise it's because I know something's coming up that's going to help with it. But please put them in the chat. If there's anything you need me to go back to or repeat, definitely let me know because I want to make sure we get that covered. This is a lot of info. I'm going to keep saying that because I feel bad. It's a lot of info. So let's look at the types of plans that fall into those 3 buckets. So the first bucket, employer-sponsored plans. Again, these are plans that an employer will set up. They are tied to your work. So these are typically not options when you leave the employer. You can't continue to contribute to the plans. You still get access to those funds potentially, but you can't keep contributing. So there are, and I'm just going to run through these because we're going to go into detail in a second. So 401k, that's one everybody's probably heard of. 403b, 457. Those are all, by the way, references to IRS code or Internal Revenue Code sections, so the tax law. Defined benefit plans, we'll talk about what that is. Profit sharing plans, and then what we call ESOPs or employee stock ownership plans. Those are all examples of employer-sponsored plans. Individual plans, just a couple of options here. The first is your IRA. So individual retirement arrangements, again, pretty common. I'm sure you've heard of these before. And then Roth IRA, which is a tax advantage type of IRA that we'll talk about. And then in terms of self-employed plans, you've got some options here as well. So you've got a simple 401k, a solo 401k, a simple IRA, and a simplified employee pension plan, which is also known as a SEP or a SEP IRA. So you've got some options there too. Okay, so Anne says, let me pull this question up. My question is about the personal side of personal finance. How do you feel reassured that you have enough for retirement? That's a great question, Anne. What I would say is a couple of thoughts around this. The first is actually sit down and look at what is retirement going to be like. I mentioned before, if you're planning on staying in your home, but you're going to have it paid off, or maybe it's not going to be paid off. So factor that in. If you've got kids, when are they going to college? Are they going to college? Is that actually going to hit, depending on your age and their age, is that going to hit when you're in retirement? When do you want to retire? What's the ideal age? Do you have access to any other retirement benefits like Social Security, like pensions, anything else coming in? What are other obligations? Are you wanting to live a retirement where you're traveling all the time and you're doing things that require a lot of money? Or are you imagining you're probably going to live a fairly simple retirement? What does that look like? So I would say start mapping out what you think you're going to need in retirement. And there are tons of calculators online. Just, if you Google how much should I save for retirement? They can help you with inflation and kind of calculating, if it's $10,000 a month today, what does that look like then? But I would start there and start mapping it out, figure out what that looks like. And then from there, you can say, okay, if I need $10,000 a month, well, what does that mean in terms of a return, a rate of return? So, if I have $1 million in the bank and I get a 10% rate every year, then I get to pull out $100,000. Is that enough? So looking at those numbers as well. Yep. So Anne says the numbers are in my favor brain, but I feel like I always need to save more feelings. Yeah, I get that. And I mean, look, I think this is all really scary, right? Because there's sort of this sense that once we get there, if we did it wrong, we're shit out of luck. For me, what I like to think about is, have I covered all my bases? So I'm saving for my son's college. I'm saving for retirement. I'm, paying down any debts we have, like our mortgage and student loans, so that we don't bring those in retirement. I'm investing over here just so that I'm building my wealth. So for me, it's about kind of, am I covering all those areas? And just sort of knowing that if I do that I am building a strong foundation for that retirement. And I do that more and more and more and more every year that I have more money. Ann says, math wise, I'll have $1 billion. If you're going to have $1 billion more than you need, Ann, then we're all going to come live with you. Lots of generational wealth. Yep. But I still feel like it could disappear or the sky could fall in. I totally get it. And you know what? The reality is it could. It could disappear. But the best we can do is plan and spread it around and make sure we're putting it in different places. We're diversifying. And I'm not just talking about the types of investments, but I'm talking about thinking about all the different aspects. You know, again, like I mentioned, paying debts down, saving for college, saving for retirement, having investments over here, and just sort of spreading it around so that if any one thing doesn't work for any reason, we've got other options. So, all right. So let's move on. I want to talk through what some of these are. I'm going to run through these really quickly, what these are, and then we're going to dive into specific ones that are most likely to be applicable for you. So I'm going to go through these pretty fast. These are definitions of all of them, but then we'll start drilling down. So in that employer-sponsored plans bucket, 401k, this is a retirement savings vehicle that employers offer. So the way these typically work is that employees can contribute pre-tax earnings through paycheck withdrawals, meaning you can put money in before it ever gets taxed, and then it doesn't get taxed, which is great. Employers, well, it doesn't get taxed until you take it out, I should say. Employers can, but are not required to contribute to employees' accounts when we have 401ks. And then, like I said, distributions, including your earnings, are taxable income at retirement. A 403b is basically a 401k, but it's offered by public schools and nonprofits. So we're not really going to talk about that one, but just putting that out there in case you've seen those numbers and you're like, what is this? That's what a 403b is. And then similarly, a 457, like a 401k, but it's offered for government employees and then certain other tax exempt organizations. A defined benefit plan is the complete opposite of the 401k, the IRAs, anything like that. Those are all defined contribution plans, meaning the plan is set up to, an IRA isn't, but a 401k is. The plan is set up based on a certain contribution being put in. I'm your employer and we'll put 3% of your compensation in. That's a defined, That's a defined compensation plan. A defined benefit plan on the flip side is a plan that says, regardless of what you put in, you're going to get X when you retire. So this is basically a pension. I know most of us don't have pensions anymore because that's the way the world has gone. But this is basically a pension. This is an employer-sponsored plan that gives you a defined amount based on some fixed formula when you retire. Monica says she's in 403b land. Yep, exactly. So you recognize that number. A profit sharing plan, a lot of people confuse this and think that this means just sharing profits. So if I make $100,000 in profits and I've got some employees, we're all going to share this, so we need a profit sharing plan. It's actually not the case. A profit sharing plan is a specific type of retirement plan. So this is where the business has profits, but those profits get invested into a retirement vehicle for employees. If you want to do what I described before, where employees just divvy up the profits and get to take them home, that's like a bonus pool. We call it a bonus pool. But a profit sharing plan is an employer-sponsored plan that gives employers flexibility in how much they contribute each year. So instead of saying, okay, we're going to contribute 3% of your compensation, they'll say, okay, we're going to have a profit sharing plan. Every year they get to determine what that profit pool is based on the profits of the business. However, there has to be a set formula to allocate it amongst the employees. You can't say, I'll give you 10,000 and you 50,000, whatever. It's got to be based on some kind of set formula. But one nice thing about the profit sharing plan is if there aren't any profits, you don't have to put anything into this retirement vehicle. And if it was a bad year. So, and then lastly, the ESOP, this is the stock option plan. This is a defined contribution plan. So I talked about defined benefit. This is defined contribution plan where employees own stock in the company. Probably not relevant for most of you in this membership, but I just want to throw it out there because this term comes up a lot and people hear it and they don't know quite what it means. Individual plans, I mentioned there were two. So there's an IRA or a traditional IRA, we would say. This is a retirement account established by the individual. It's not linked to your employment. So once you set it up, you've always got it. You can take it with you wherever you go. It allows you to make tax deferred contributions if you meet certain criteria. And those two criteria are your income level and whether or not you have access to another retirement plan, either yourself or your spouse, if you file with a spouse. But assuming you meet those criteria, which we'll talk about, you can deduct any contributions you make to your IRA account up to a certain amount. Or if you, I'll leave it there. Contributions are, let's see, I already talked about that. Distributions and earnings are taxable income in an IRA, assuming you took the deduction when you contributed them. If you put money into an IRA and you don't qualify for that deduction, then the distributions of those contributions are not taxable income when you retire, but your earnings still are. So you make money, you're paying tax on it, basically. The Roth IRA is a really interesting vehicle because this was set up to promote retirement savings in lower and middle income families. And it's a really cool benefit that doesn't exist very often in the tax world, which is that it gives you sort of a double, it allows you to make money tax-free, I should say. And so the way this works is, so it's an IRA account like a traditional IRA account, except you cannot deduct your contributions that you put into it. Now that sounds bad, but the cool thing is on the flip side, the distributions you take out of it when you retire plus earnings are tax-free. So you're putting in post-tax money. So you're putting in money you've paid tax on, but all the earnings that money makes are tax-free provided you take it out, at a certain age and you meet some other criteria, but generally pretty good. Now, the downside to the Roth IRA, or the trick with the Roth IRA, is that once you hit a certain income level, you can't contribute to a Roth IRA anymore. Again, I told you this was really designed for lower and middle income families. There is something called a backdoor Roth IRA, which allows folks who make more money than the Roth IRA limits to still put money into a Roth IRA. We're not going to talk about that today. It's a very complicated situation. If you fall into this and you're interested about it, talk to your accountant. This is definitely something that they can help you with. Sometimes it makes sense. Other times it doesn't. It's not pros and cons, but just want you to know that. So that is the Roth IRA. Now, in terms of the self-employed plans, oh, yes. Okay. So Monica says, my mom got me a Roth IRA for my 21st birthday. It's so nice to have. It really is. And I will say this. I generally, hold on, I'm turning my little message thing off so it stops doing the dingy ding thing. I normally try not to say like, you should do this or, whatever when it comes to retirement accounts, because there's so many different options. But I will say that if you've got kids, it's not a bad idea to think about adult kids, I should say. It's not a bad idea to think about possibly, and this is a great thing for you, to think about, can I set something up for them? Like the Roth IRA. Again, there's rules. You got to make sure everything's in order there, but it's definitely a good thing. Anne says, backdoor Roth. Do I pay for one of your packages, figure this out together? Do we tackle it in quarterly meetings? More info, welcome. So Anne is one of my incredible annual tax prep package clients. And Anne, it's a great question. We will definitely talk about this in our quarterly meetings. This is something that we can do. And for folks who are not part of our annual tax prep package, one of the benefits of it is when we get to year end, so Anne, this is coming soon, we actually send out a ton of information about year-end stuff you should do. Retirement is the biggest thing. And we talk about the backdoor Roth. So for folks for whom it makes sense to do, we give you the details around how to do that. So we don't actually do the backdoor Roth for you. It sounds like this big fancy thing. It's really not. But you do it through your investment brokerage or whatnot. But we kind of tell you what you got to do to put it together. So, and we'll definitely cover that. You don't need to pay for anything else. That's included in your annual package. All right, self-employed plans. So the solo 401k is similar to a 401k, but it's designed for business owners or folks who are self-employed, as long as you don't have an employee. If your spouse is employed in your business, you can still do this, but that's the only exception. You cannot have employees otherwise. This is a great option if you have a lot of money you want to contribute. So you're feeling like you're feeling a little maxed out on some of the other options, or you want the flexibility to increase or decrease your contributions as your business profits vary, because there's no required contribution for this plan. You can put in what you want up to the limit. So it's a great option for that. Let's see. come back over here. So the simple 401k is sort of the next level 401k. It's similar to the traditional 401k plan, except it's simplified. It's designed especially for small business owners that have fewer than 100 employees. So if you like the idea of a 401k, but you've got an employee, so you can't do the solo, this could be an option for you. The biggest difference with the simple 401k versus a regular traditional 401k plan is that the employer, which is you, even if you're self-employed, has to make either a matching contribution of up to 3% of the employee's pay. So meaning if an employee puts money in, you have to match it, or a non-elective contribution of 2% of their pay. So whether or not they make contributions, you are putting 2% of their compensation into the plan. So basically, you're required as the employer to contribute for them if you do the simple 401k. We're going to talk in a little bit about the benefits of why you might do the 401k, the simple 401k, because you might be sitting there thinking, well, why would I do this? I don't want to commit to this. There are some benefits to it. A safe harbor 401k is like the next level 401k. So you got solo, simple, safe harbor, traditional. So the safe harbor offers the benefits of the traditional 401k plan, but it allows you to qualify for the safe harbor rules, which then allow you to avoid the annual non-discrimination testing normally required by the IRS. We're going to talk about what non-discrimination testing is in a minute, but let me just tell you, if you can get out of non-discrimination testing, you want to, because it's a pain in the butt. It's like it says there, an annual reporting requirement. And it's a lot of admin work. So this is like the next level of 401k that gets you most of the benefits of the full 401k, but gets you out of doing that administrative burden. Again, though, and we'll talk about this when we get to the details, at this point, we're talking about something where you have employees. If you're a solo, you're certainly not going to do this safe harbor 401k. It's not worth it. Okay, simple IRA. So this is an option if you want to have an IRA plan available and you've got employees. So you wouldn't necessarily do this if you didn't have employees. It's available to small businesses with fewer than 100 employees. It allows both the employees and the employers to contribute to a traditional IRA that's set up for each employee. It does, however, have employer contribution requirements similar, or actually exactly the same as a simple 401k. So you would do this if you wanted to offer your employees a retirement vehicle, and you liked the idea of it being an IRA. The SEP, or the SEP IRA, allows employers to contribute to traditional IRA set up for employees as well. Any size business can set this up. There's no limitation in terms of number of employees. However, there's two things to know about the SEP. Number one, only employers can contribute to it. Employees cannot. And number two, the employer has to contribute the same percentage for every eligible employee. So if I want to contribute 10% of my compensation, I've got to contribute 10% of the compensation of every eligible employee for it to qualify under the SEP plan. And again, we're going to go into all of these details in a second. So, all right, let's see. So the big question then becomes, well, which one do I choose? Because that was a lot of information, and we're just going to have, frankly, even more information coming up here in a second. So hold on, I'm closing my Slack. Now I know it's dinging. It's my Slack. Oh, it drives me up a wall. Okay. So we're going to talk about each one a little more in depth, and then we're going to kind of wrap it up, and I'm going to give you some guidance as if you're this, focus on this. So the three groups that we're going to really look, because I've told you about a ton of different plans, but I want to now focus us in. So the three groups of plans that I want us to look at, we're going to look at the IRAs, two versions of IRAs. We're going to look at the individual IRA plans. Remember, these are the ones you set up regardless of your employer or business, and that's the traditional and the Roth. We're going to look at the business IRA ones, so the simple IRA and the SEP IRA. And then we're going to look at the three 401k options I mentioned, the solo, the simple, and the safe harbor. We're not going to look at that traditional IRA because you're probably not going to choose that option unless you have a lot of employees. And I'll talk about kind of when we get to safe harbor, the differences there. So traditional IRA, again, this is the one that you can do, or one of the two that you can do regardless of your employer, regardless of your business. You set this up as an individual. This is great for folks who are self-employed, who don't have any employees, don't have a ton of money to contribute either. You don't need a plan that has a huge contribution limit. You just want to get started. You want to get started saving for retirement. The contribution limit for a traditional IRA is $6,000 in 2021. Note that all of these numbers I'm talking about are going to be for 2021. They are subject to change. The IRS does typically increase these amounts a little bit not all the time, but sometimes every year. So $6,000 in 2021 or $7,000 if you're 50 or older. There is no income limitation to set up a traditional IRA, so anyone with any income level can set one up. However, you can only deduct your contributions up to a certain income level. And that number, the reason I don't have that number on the screen is because it actually varies quite a bit depending on whether or not you have access to another retirement plan. So I mentioned a few minutes ago, if your spouse has an employer-sponsored plan, if you have an employer-sponsored plan, both of those will limit the amount of your IRA contributions that you can deduct. And so keep that in mind as you're thinking about, and it'll say like, if your income is up to a certain level, you can deduct 100%. If it's beyond that, you can only deduct a certain percentage. So you need to make sure you're aware of those limitations if you're doing a traditional IRA and you or your spouse has access to another plan. The tax benefit of a traditional IRA is now. So assuming you qualify for that deduction, you can deduct those contributions now. It's going to reduce your taxable income today. But keep in mind that the offset of that is that when you retire, all the money that you take out of your retirement account is taxable income, both the contributions you put in because you never pay tax on them and the earnings. So tax benefit now, no tax benefit later. Doesn't matter if you have employees or not because these are individual plans. Doesn't matter. It's nothing to do with that. You have to set up your plan by April 15th for the prior year. So if you want to take advantage of those contributions in 2021, you need to set up your plan by April 15th of 2022. Similarly, you'd need to contribute any money you want to contribute by April 15th of 2022 for the 2021 year. So it allows you to look back a bit. Some distribution rules for traditional IRAs, these are very similar to many of the other plans. So the first is that if you withdraw any amounts from your IRA before you are 59 and a half years old, you will get hit with a 10% early withdrawal penalty. There are some exceptions like buying your first home, medical, they waived it for the COVID-19 pandemic. So there are some exceptions, but generally expect that once you've put your money in, you're not taking it out without paying that penalty. And I would not recommend taking it out if you can avoid it. Traditional IRAs do also have required minimum distributions. They kick in at age 72. This may not seem that important right now. You're like, yeah, it's a long time from now. What do I care if it's going to make me take money out? Well, it matters for a couple of reasons. Number one, if your money's in there and it's earning you a lot of money, you don't want to take it out unless you have to. So not awesome that it has these required minimum distributions. The second reason is because it's going to add to your income, right? So taking money out that you don't need, if you don't need it, may bump you into the next tax bracket when you otherwise didn't need to be there because now you're taking money out you didn't need. So just a couple of things to think about. And then lastly, you cannot loan money from your traditional IRA. So some of the other accounts you can, so they will allow you to basically take a loan that can be paid back without penalties, if you will. You cannot do that with the traditional IRA. The Roth IRA, very similar to the traditional with one big exception. So the Roth IRA is also great for self-employed folks. You don't have employees. Again, it doesn't matter. This is, it's not connected to your business. Again, it's great if you don't have a lot of money to put into retirement because that contribution limit is that $6,000 or $7,000 if you're 50 or older. However, there is an income limit with the Roth IRA. I mentioned this before. If your modified adjusted gross income, that's a fancy number or fancy name for a number that sits on your tax return. If your modified adjusted gross income is $140,000 or more if you're single, or $208,000 or more if you're married filing joint, you cannot contribute to a Roth IRA. And the amounts do phase out, but you are not allowed to contribute to a Roth IRA unless you do the backdoor Roth, which we're not going to talk about today, but unless you do the backdoor. You know what? Yeah, thank you. And it's funny because I put the MIGI on my screen and I was like, that looks like MAGA, not MAGA, Maggie, MAGI, modified adjusted gross income. That's what we're talking about. Monica says, dealt with this with my mom's IRA when she turned 72. Yep, those required minimum distributions are not always fun. And it's one of those things you're like, that doesn't sound bad that I would get money, but actually it can have some negative consequences. So the benefit of the Roth IRA is the opposite of the benefit of the traditional. You don't get the benefit today. You get it in the future. So no tax benefit today, no tax deduction today. Ooh, excuse me. When you take the money out at retirement, those withdrawals are tax-free, both your contributions, because you've already paid tax on them, and your earnings, because that's the cool benefit of the Roth IRA. This is why folks will do the backdoor Roth IRA sometimes, because they get that added benefit. There's one other benefit you're going to like to in a second. Doesn't matter if you have employees or not. This is not connected to your business. And like the traditional IRA, the deadline to both set up the plan and contribute is April 15th of the next year. So if you want to do it for 2021, you've got till April 15th, 2022. I just want to make one note about that really quickly. You're going to see with some plans coming up that the deadline is your tax filing deadline with extensions. This deadline is April 15th without extension. So even if you extend your tax return to October, doesn't matter. April 15th is the deadline for this purpose. So I just want to make sure that's clear. In terms of distributions with the Roth IRA, so there's no penalty on Roth IRA contributions. That should say distributions, not contributions. No penalty on Roth IRA distributions because it's post-tax money. You've put in money you've already paid tax on, so they don't care if you take it out. However, that said, you can't put it back in. So if you take it out, you can't put it back in. But there's no penalty on that. There is a 10% early withdrawal penalty on your earnings. So if you take distributions before age 59 and a half, and part of those distributions are earnings, then you will pay the 10% on those. Again, there are some exceptions. This is the other benefit of the Roth IRA, no required minimum distribution. So this is a really nice feature for folks in addition to the tax benefit, because it's not going to force you to take money out. There are some requirements where your beneficiaries may have to do required minimum distributions, but that's so far down the line that we're not going to worry about that one. Like a traditional IRA, you also can't loan money or you can't borrow funds from your account as well. All right, just going to take a breath, making sure there's I don't see any questions so far. Oh, I'm sorry. Ann says, I missed one. Ann says, traditional IRA required minimum distributions. What's the general math behind this? It's a great question, Ann. Let me pull up what the, it's not easy, but let me see if I can pull it up. Okay, so, and it is, I forget exactly how they do it. Give me 1 second because I want to tell you this. Okay, so basically there's a worksheet and there's a table, which is what I was trying to pull up to see if I could summarize for you how this works. But basically they look at your marital status, so whether you're unmarried or not, and they look at your life expectancy. So, and I wish I could pull this up on my screen, but I can't. So there's like this whole table where they look at your life expectancy and then they determine, okay, you need to take this percentage out. So it's a complicated formula. Not going to explain it on today's live. You and I can definitely look at it if you want. But, again, this is one of those things where it's not inconsequential. I mean, it potentially can be frustrating because you may have to take this large amount of money out that you have to pay tax, depending on what account you choose, pay tax on. And you may not want to have to do that if it's making you lots of money. So, all right. Let's move on to, let me get rid of the question. Let's move on to the simple IRA. So now we're into those self-employed accounts. So the simple IRA, this is a great option if you have employees, up to 100 employees. You still need to be a small-ish business, but you can have employees. The contribution limit here is going to be more than with the traditional or Roth IRA. You can contribute up to $13,500 plus $3,000 if you're 50 or older. There's no income limitation on who can have these accounts, so you're not phased out or anything like that there. And then the tax benefit is similar to the regular IRA, where the contributions are pre-tax. So If you pay me $1,000 in wages, I can put 500 into my simple IRA, and that 500 isn't going to be taxed today. So it's effectively the same as getting a deduction for it, if you will. On the flip side, though, when I take that money out, I'm going to pay tax on it in the future upon retirement. So tax benefit now, tax liability gets pushed down the road. However, the business also gets a deduction for any employer contributions that they do. So if you contribute for your employees, you'll get a deduction, a tax deduction for that as well. So that'll reduce your taxable income for the year. Now, if you have employees, this is where it starts to get a little dicey. So first and foremost, employees can contribute to this account. That's a key feature. A lot of once you start having employees, a lot of employers want their employees to be able to contribute. This is to help them promote them saving for retirement. This is where something like the SEP IRA, which does not allow employees to contribute, doesn't become a great option once you have employees. Whereas a simple IRA is, because employees can contribute. The trick, though, here is that employers do have a contribution requirement. You are required to either match their contributions up to 3% of their compensation or make fixed contributions of 2% of their compensation, whether or not they put their own money in. So you do have that requirement in order to be a simple IRA. And eligible employees, I should have said this is the case for eligible employees. Eligible employees are folks that have earned at least $5,000 during any 2 years before the current calendar year and expect to receive at least $5,000 during the current year. So if they meet those requirements, they're eligible, and therefore you have to make that required contribution, whichever option you choose. The plan setup deadline here is early. It's October 1st. So if you wanted a simple IRA for 2021, you've actually missed the deadline. It has to be October 1st of the year in which it's basically taking effect. However, the contribution deadline is within 30 days that payments are taken out of your employees. Taken out of your employees' paychecks, or January 30th. If you are the employer, you can make contributions up to January 30th of the following year. Hold on, let me I turned my do not disturb on, but it came off, so we're gonna turn back on. In terms of distributions, very similar to what we talked about before with the IRAs, 10% early withdrawal penalty before age 59 and a half. However, it's 25% if you take money out during the first 2 years you have the account. So there's a big penalty in those early years. Required minimum distributions at age 72, and you cannot take a loan from this account. Okay, let's see, where am I? Nope, just kidding. All right, let's talk about the SEP IRA. So this is a great option if you have no employees or maybe a couple employees, maybe they aren't eligible employees, but this is not a great option once you start having employees for a couple of reasons. The contribution limit, however, though, is big. This is why this is a nice option if you don't have employees. So the contribution limit on a SEP IRA is the lesser of $58,000. That amount does change every year, or up to 25% of your compensation or your net self-employment earnings, up to $290,000 of compensation. So basically, $58,000 is the max you can do no matter what. There's no income limitation. So anyone with any income level can have this account. The only income limit is just how much you can put in. The benefit here is that the business gets a tax deduction for the contributions they make. And remember, I said only the employer can make contributions. And by the way, when I'm saying employer, if you're self-employed, that means the business can make contributions, not you, the employee or the worker. But the business gets a tax deduction for those contributions. Distributions are taxable income, much like with a regular IRA. So we get the tax benefit now, we don't get it in the future. There's no Roth version of this. Sometimes you'll see with some of the IRA plans, they'll have like an option to make it a Roth if you qualify. And you can check that box and then it flips to the Roth rules. That's not an option in the case of the SEP IRA. So if you have employees, you have to contribute an equal percentage of compensation for every eligible employee. You can do 20%, but you're going to have to do 20% for everybody. Anne says, are SEP IRAs okay for S Corps? Absolutely. And this is actually where I often see them. The only trick here, Anne, is when you have employees, because of what I just said, that you've got to contribute equally. So once you get to that point, a SEP IRA may not make sense anymore, but SEP IRAs are perfectly fine for S Corps. I had one, I still have one in my S Corp. I'm phasing it out because I have employees now, so I'm starting with a 401k. But yeah, absolutely okay. In terms of who counts as an eligible employee for the purposes of these required contributions, anyone who's 21 or older, anyone who's worked for your business in at least 3 of the last 5 years, and anyone who has received at least $650 in compensation. So if they hit those 3 things, they're an eligible employee. You have to contribute the same percentage for them that you do for yourself. Plan setup deadline and contribution deadline in this case are more generous. They are your business's tax filing deadline plus extensions. So if you're an S corp March 15th and you extend to September 15th, you've got until then to get this set up for the prior year. Anne says contribute equally in dollars or percentages. No worries. Yeah, so percentages. So you're choosing a percentage. So if I make $100,000 and my employee makes $20,000, and I would choose 10%, I can put in 10 grand for myself and 2 grand for them. That's fine. It's the same percentage, but that adds up pretty quick, as you might imagine. And especially when you're the business owner, you may want to put in more than you want to kick to your employees. So, okay, let's see, where are we? And so last thing in terms of distribution rules for SEP IRAs, 10% early withdrawal penalty, again, before age, that should say 59 and a half, not 59. Same required minimum distributions, and you cannot take a loan out of the account. So you're going to see those similar rules. There are a couple plans that change those up, but for the most part, those are the rules. Solo 401k. So the solo 401k is a great option if you want to get into the 401k world, but you don't have employees, therefore you don't need to set up a full 401k plan. It has this a similar contribution limit as the SEP IRA, which is why it's a nice option. But never mind. I take back what I was about to say. So same contribution limit, maximum of $58,000. However, because it's a 401k, it looks at the 2 parts. It looks at the employer contribution and the employee contribution. So unlike the SEP IRA, you can have an employer and an employee piece. It's a little bit silly because with the solo 401k, you can't have it when you have employees. So you're wearing both hats. You're both employer and employee in the solo 401k. But they still look at it like employer-employee. So the employee contribution is up to $19,500 or 100% of compensation, whichever is less, plus a catch-up contribution of $6,500 if you're 50 or older. The employer can contribute up to 25% of your compensation with a compensation limit of $290K. But that max of total contributions, employer-employee, is $58,000. And if you're a sole proprietor, if you're a single member LLC, so you don't have that employer-employee relationship, then you can do 25% of your net self-employment income, which is basically your net profit minus that 50% self-employment tax deduction that you get on your return. There's no income limitation in terms of setting one up. So anybody with any income can have one of these 401ks. But again, that compensation limit of $290K in this year, at least, to determine how much you can put in. Much like a regular 401k, contributions are pre-tax, so you're getting that tax benefit today. When you take money out in the future, that's going to be taxable income. All right, so with employees, this is easy. If you have them, you can't have a solo 401k with the exception of your spouse. Your spouse can be an employee and have a solo 401k, and they can be part of that solo 401k. They'd have their own, I should say, actually. So plan setup deadline by December 31st. If you are taking money out of, if you are on payroll, basically, and taking money out of your paycheck, you need to have it set up by December 31st. Otherwise, March 15th if you're an S corp, April 15th if you are just a single member LLC or sole proprietor. Contribution deadlines, same thing. With a solo 401k, there is a Roth option. So you can also choose a solo Roth 401k. It's going to mimic the Roth IRA rules. And so you're going to get that tax benefit in the future, not today. Distribution rules are basically going to be the same as what we've been talking about. That 10% early withdrawal penalty if taken out before 59 and a half, required minimum distributions, but they do have loan options. So if you want to be able to loan money out of your retirement account, this is an option for you. So Anne says, SEP versus solo 401k, major difference seems to be how much you want other employees to have. Sort of. So the first big difference between the two is because the SEP and the solo 401k basically have the same contribution limits. The biggest difference is a solo 401k, you cannot have employees. So the minute you hire an employee that counts as an eligible employee, you got to not get rid of it, but you have to stop funding the solo 401k. With the SEP IRA, you bring on employees, you can continue to fund the SEP IRA. You have to also fund for them, but you can continue to fund it even beyond hiring employees. So that's actually the biggest difference, I would say. And then some other small differences. The SEP IRA, you can't do loans. You can do a loan with the solo 401k. Yeah, and with the solo 401k, that's probably the biggest. Those are the biggest ones. Okay, so now let's look at, hold on, I lost mine. Now let's look at the simple 401k. So remember the step here. Solo 401k, can't have employees, that's where you start. Simple 401k is the next option. This is great for larger businesses that have up to 100 employees. You want the features of a 401k, but the simplicity of an IRA. Your contribution, though, notice isn't as high, your contribution limit. It's only up to $13,500 plus the $3,000 catch-up if you're over 50. It's not the higher contribution limit. So if you are in the 401k world, but you bring on employees, so you can't do the solo, and you're like, well, maybe I'll move to the simple. You just got to know that it's going to have a much lower contribution limit. Again, there are no income limitations. Anyone with any income can have one, but the compensation cap for the purposes of doing any kind of calculation is $290K. Tax benefit, same thing. Your contributions are pre-tax, so you're getting that benefit now. Distributions, when you take them out in the future, are taxed. The business does get a deduction for any employer contributions. Anne says, gotcha, my helper is my husband, so his contractor versus employee status is more flexible than other setups. Yeah, exactly. Okay, let's see. Simple 401k. So the employees can contribute to this, which is a nice change from a SEP IRA where employees can't contribute. Employers are required to either match contributions up to 3% of the employee compensation or make fixed contributions of 2% for eligible employees. So again, if you can't do the solo 401k because you have employees, you move to this, but keep in mind, you're going to have required contributions as an employer if you do this plan. Plan setup deadline, similar to other 401ks, is early. It's October 1st of the year in which it takes effect. Your contribution deadline, again, you've got 30 days once you've taken deferrals out of employees' paychecks to put them into the account, or if it's an employer contribution, January 30th, so 30 days after year end. And distributions, same story here. 10% early withdrawal penalty, required minimum distributions. Loans, however, are permitted with the simple 401k. All right, we're almost there. We're getting so close. Hang in there, everybody. All right, so the Safe Harbor 401k. So this is that next level 401k. This is if you're like, look, I have employees. I want them to be able to participate in my retirement account. I want to be able to participate in my retirement account. I want a higher contribution limit. And I am okay with some employer contributions, but I don't want to go the full 401k route because I don't want to deal with the non-discrimination rules, which I'll talk about in a second. The contribution limit here is going to be similar to what we saw with the solo 401k or the SEP IRA. It's that same $58,000 broken into two components. Employees up to $19,500. Employer can do, well, I'll show you those kind of in a second, but employer can do contributions as well. In total, $58,000, okay? What's nice about the 401k here, remember the SEP IRA, employees can't contribute, so the employer is doing all the contributing, and the employer has to pick a percentage that everybody gets contributed, right? What's nice about the Safe Harbor 401k is the employee is doing the contributing here. So, or can do the contributing here, I should say. So as an employee, again, two hats, right? As an employee, I can contribute up to $19,500 regardless of what anyone else in the company does. That's me as an employee putting my own money in. Cool, right? Pre-tax. The employer, again, putting my employer hat on, can contribute the remaining amount between the $19,500 and the $58,000 with some rules, which I'll talk about in a second. But the employer can kick that part in as well. So it kind of breaks it up a little bit so that not as much of the contribution has to be the same across the board, because a good chunk of that can come from the employer piece. I'm sorry, the employee piece, which doesn't depend on what other people do. Hopefully that made some sense. There are no income limits here in the sense that anyone can have one. And in fact, all eligible employees have to have access to one. You can't just pick and choose. Doesn't mean they have to contribute, but they have to have access to one. Tax benefit is now, contributions that go in now are pre-tax. Distributions are taxed when you take out the money in retirement. The business gets a deduction for any contributions that they make. Okay. If you have employees for a safe harbor 401k, which to be honest, don't set one up unless you have employees. It's not worth the administrative burden. There are three options you can choose to qualify for the safe harbor. And remember, the safe harbor gets you out of that annual required non-discrimination testing that the IRS makes you do. So we want to qualify for the safe harbor. The three options as the employer that we can choose is to do a basic match, meaning we match 100% on the first 3% of compensation. So if somebody puts in $1,000, we would match $1,000 up to 3% of their compensation. And then 50% match on the next 2% of compensation. We can do an enhanced match where we match at least as generous as the basic one on each tier. So basically we'd look at, okay, what would they get under the basic plan? We have to be at least as generous as that. Typically, folks who do this option will say, I'm going to contribute as the employer 100% of 4% of their compensation. So if they put money in, I'm going to match 100% up to 4% of their compensation. And then the last one is the non-elective. This is where the company just contributes money for you, whether or not you, the employee, put money in. I will tell you in my business, this is the one I do. Not because it's necessarily cheaper or simpler, but because I believe retirement savings is really important and I want my employees to have that benefit. So this is the one that is included in our 401k plan. So in this case, if you do the non-elective, you would contribute 3% or more of each employee's compensation to their 401k plan, regardless of what they contribute. And in terms of eligible employees for this, so anyone that you have to include in this, it's anyone who's 21 years or older and anyone who's been with you at least a year. You can include more people, but those are the people you're required to include. Plan setup, deadline for this is 3 months prior to year end. There's a lot of rules around this. If you're setting up a safe harbor 401k, you're not doing it alone. You're going to do it through through a company that does this. I personally use Guideline. They've been great so far. We're newer with them, but we like them so far. But there's lots of companies out there that do this. Contribution deadline is going to be similar to all the other 401k plans, where if you're taking, if employees are deferring payments from their paychecks, they need to be deposited in the account within 30 days. The employer contribution, in this case, can actually be done by the employer's tax filing deadline, including extensions. So I can actually make a contribution for 2021 by October 15th, 2022, which is nice. From a cash flow perspective, very nice. Distribution rules, same thing here, 10% early withdrawal, required minimum distributions, loans are permitted. Okay, we are so close to the end, so hang on. I know this is a lot. We're getting there. We're doing so well. So a couple of notes I wanted to remind or reiterate at this point. First and foremost, IRA and 401k contribution limits are per person, not per plan. So if you go set up a traditional IRA and a simple IRA and a SEP IRA or whatever, actually not SEP, take SEP out of it. I shouldn't have said that. The limit is the limit across the board, not per plan. Okay. So if you give to one, you have to factor that in when you're looking at what you can give to another one. The exception is the SEP IRA. So your SEP IRA contributions don't count for your other IRA plans to the extent you have them. And this is per year, again, remember. So there's nothing necessarily wrong with having one type of account this year and then another type of account the next year if your situation changes and something makes more sense. The other note I wanted to put out there is about those non-discrimination rules that I mentioned. So what we call qualified retirement plans, which are 401k, SEP, simple IRAs, all of those, have non-discrimination rules. These rules state that all employees of a company must be eligible for the same benefits no matter their position. And the idea here is because they don't want companies giving really awesome benefits to the C-suite and really shitty benefits to everyone else. Now, typically this is not an issue because as you may recall, if you go back to the requirements of some of the plans we've walked through, it says like SEP IRA, it's got to be the same percent. With the other ones, you've got to do like a certain percentage or, whatever. They have rules built in to protect you from this. That said, when you get to a full traditional 401k, the IRS requires you to do annual non-discrimination testing, which is a pain in the butt. You don't want to have to do it. And so that's why we look at doing something like that Safe Harbor 401k, which basically says, as long as you follow these rules, let's go back here for a second. As long as you choose one of these match options and follow these rules, then you'll qualify for the Safe Harbor, and you don't need to do that non-discrimination testing. So if you do have employees and you want to have a 401k, make sure it's a Safe Harbor 401k. Okay, really quickly, I want to run through the pros and cons of each to kind of help you decide what makes the most sense for you. Traditional IRA, the pros, easy to set up. I can set one up in 5 minutes right now. It's not tied to your business or your employees. So whatever you do in your business doesn't affect it. Whatever, if you change jobs, doesn't affect it. You will possibly get an upfront tax deduction if you qualify based on your income and access to other retirement plans. So tax savings today can be really nice. And it's got low complexity. You don't have to do any annual reporting. There's nothing complicated to this thing. Okay, sounds good. Thanks for being here. From a cons perspective, the contribution and deduction limits, deduction are limited if you have other retirement plans, access to other retirement plans, or your spouse has access to other retirement plans. So you may actually end up in a situation where you can't get any upfront tax benefit from the traditional IRA. And then it's like, well, why bother? It does have a low contribution limit compared to some of the other options. Your earnings are taxable. So compared to the Roth IRA, earnings of the traditional IRA are going to be taxable when you take them out. And it does have required minimum distributions. The Roth IRA, similarly, is easy to set up, not tied to your business or employees. The benefit here is that you get the tax-free earnings at retirement. So it's kind of a con now because you don't get the deduction now, but you get these tax-free earnings. So all that money it's making for you over all these years is going to be tax-free. That's huge. That's awesome. And it's fairly low complexity. The cons are you can't contribute if your income is over a certain threshold, with the exception of you can do a backdoor Roth, which is complicated and we're not going to talk about today. It does have a low contribution limit. It's at $6,000. And again, you don't get an immediate tax deduction. With the simple IRA, it's easy to set up. It does offer a contribution option for your employees, which is great. So it's not just reliant on employer contributions, but it has those low contribution limits of $13,500. It does have mandatory contributions if you have employees. So that can be burdensome as the number of employees increases or what you pay them increases. And there are early withdrawal penalties. With the SEP IRA, also relatively easy to set up. It's got higher contribution limits, which is great. And it's got fairly low administrative burden, doesn't really have any annual reporting requirements that you need to worry about. But on the flip side, you are locked into contributions if you have employees. It's got to be that same percentage across the board. And only you, the employer, can contribute. So from an employee benefit perspective, it's not great that they don't have a plan they can't contribute into. You also can't borrow the funds with a SEP IRA. With the solo 401k, you do get the higher contribution limits similar to the SEP IRA, which is great. These are fairly easy to set up. What's nice about these is it makes it pretty easy to control these depending on your business profits, because you can just decide every year what you want to put in there. You don't have all these fancy rules about what you've got to put in. Some solo 401k plans do allow for post-tax Roth contributions. So if you qualify for that, you can turn it into a Roth. And you can take loans from the account, which is great. On the flip side, you can't use it if you have employees. So the minute you've got an eligible employee, the plan is ineligible for you. It does have required minimum distributions, and it does have annual reporting requirements that you have to be aware of. The simple 401k is easy to set up. It's fairly cost effective compared to a full traditional 401k plan. It does offer a contribution option for employees, which is great. So this is an option if you have employees. And it's not subject to the non-discrimination rules that the 401k plans are, which is another huge benefit. But on the flip side, it's got a low contribution limit, and it caps out at a certain income level. It also, again, has mandatory contributions, which as you bring on more and more employees or you're paying them more, can be very burdensome. It does have early withdrawal penalties, and you actually cannot offer any other retirement plan to your employees if you have a simple 401k. So just keep that in mind. The Safe Harbor 401k finally is offers a contribution option for employees, which is great. So if you've got employees, this is a good option. There's no income cap on the matching, so you can actually match as high as as possible, as high as you want to. And it does avoid the annual IRS non-discrimination testing, again, because you choose one of the options for employer contributions, and that's how you fit into those rules. On the flip side, though, the cons are it does require more setup. It can be a little bit more expensive to maintain. It's got some ongoing compliance you got to do, and it does have those required employer contributions. So everybody deep breath. That was a lot. We're like, I think I got like 2 slides left. We're so close. No, I lied. I got like 5. But this is the, no, just kidding. 4. But we're getting to the end, and I want to give you now, I want to bring it back and summarize and tell you, okay, based on where you're at, what makes sense for you. So I want to first bring you back to those questions I said to ask at the beginning, thinking about the factors that affect which plan makes the most sense for you. So first and foremost, are you planning on hiring employees, or do you currently have employees? And what does that look like? Do you have, are your employees eligible employees, meaning do they hit the criteria? Are you planning on keeping employees long-term? Are you planning on growing your team? What do you, how much do you pay them? Like all of these things will factor in what that will cost you under each of these plans. Also, how much do you plan to contribute? If you come to me and you say, I can only throw in $5,000 for the next few years, I'm not going to put you on a SEP IRA or one of these other fancier plans because you're not going to take advantage of that huge contribution limit. So I'm not going to lock you into that. I'm going to put you in a Roth IRA or a traditional IRA. So think about that. What do I have to actually put into this? What is your current income level? And also, what do you expect retirement? Because again, that will affect how much you can contribute. It'll also affect your tax rates. If your current income level right now is lower, meaning your tax rates are lower, then it probably doesn't benefit you that much to open up a traditional IRA and take the deduction for contributions, because if your tax rate is 12%, you're going to put, I don't know, $5,000 in, and you're only going to save like $600. I mean, that's not a huge amount compared to having to put $5,000 in the account. On the flip side, if your tax rate is 30%, putting that $5,000 in saves you $1,500. Like that's a pretty decent tax savings. So think about things like that. And then lastly, do you have access to other retirement plans, or does your spouse have access to other retirement plans? Because again, that can limit how much you can deduct in some of these plans when you make contributions. All right. So depending on what phase you're in, I have recommendations for you. Now, these phases correspond to the phases we talk about in the membership, which some of you may be familiar with, some of you this may be a little newer. So I'm just going to very briefly explain each phase. There are 4 of them, but phase 1 is typically for folks who are just getting started. You're just getting stuff set up. You're probably a sole proprietor. Maybe you're a single member LLC. You don't have any employees. Maybe you're profitable, maybe not quite profitable just yet. Even if you are profitable, you're not making huge profits yet. So you've got a little bit of money to put in retirement, but not a huge amount. If this is you, my first recommendation is a Roth IRA, assuming you your total income, your MAGI, is underneath the threshold it needs to be at. This is what I would recommend for you, is that Roth IRA. You're not going to get that tax deduction now, but you're going to get that huge benefit of those earnings being tax-free down the road. Then if you want to put more money in, or if you can't do the Roth IRA because of income, go to a traditional IRA. So assuming you're not limited by other plans, like assuming your spouse doesn't have a plan that limits your deductions here. So meaning assuming you get a deduction for contributions to your traditional IRA, I want to see you do the traditional IRA because that'll get you that tax deduction. It'll get you starting to save for retirement, but it doesn't get into any of the headaches of the self-employed retirement plans. Lastly, if you want to put more money in, or if you can't do the Roth IRA, or you can't qualify for the traditional IRA tax deduction, then I want to see you go to a solo 401k plan. You don't have employees, so that's not a problem. It's a great way to start saving for retirement. It's going to get you some benefits, and it's got a higher contribution limit. So as your profits increase, you can put more and more in. Okay, if you're phase 2, so these are my folks who have everything set up. They've got the foundational stuff in place, that you've maybe been in business a year, a couple of years, 3 years. You're probably a single member LLC. Maybe you're still a sole proprietor, but you've probably got the LLC. Maybe you're an S Corp, but probably not quite yet. You've got profits, they're growing, so you're starting to have more and more money to put in, but you still don't have employees. First and foremost, that Roth IRA, again, if you can qualify with your income, definitely get that fully funded. Next, look at a solo 401k for the same reasons I said about my phase one folks. And then lastly, look at a SEP IRA. At this point, if you're starting to have enough money to be able to put a lot more in, the SEP IRA is a great option for you. You don't have employees yet, so we're not worried about those contributions. And it's a good holdover until you do bring employees into your business. If your phases 3 and 4, so these are my higher level folks. These are, you probably have a single member LLC or multi-member LLC. You're almost certainly an S Corp, or if you're not an S Corp, it's because we've talked about it. It doesn't quite make sense yet. You've got employees, or you're thinking you're going to be hiring soon. For you, looking at something like a simple 401k, but being aware of the limitation on contributions, or going to the full Safe Harbor 401k, getting that set up through a program like Guideline or any one of the other online companies that does it. That way you've got something to offer your employees. Yes, you're going to be making some contributions for them, but you're building that into your compensation structure. You're getting the tax deduction as a business for that. And for you personally, you're able to put a lot of money into your retirement account, both as an employee and also as an employer, so you can really boost those retirement savings. All right. We are done. We've made it. We're only 8 minutes over. Thanks to everyone for sticking in there. I know that was a little bit longer than normal, but it was a lot to get through. Deep breaths. This is a very weighty topic. As you can see, it's very complicated. Every plan has all these different nits to it. Every year, the numbers are changing a little bit. It's really, really important that you talk to your accountant about this, because even though I've given you some recommendations, they will see your full picture and they will understand what makes the most sense for you. If you're not in a place yet where you have an accountant, you're just not there yet, then you're going to be here. You're my phase 1 folks, and you're going to do that Roth IRA if your income qualifies you for it, or that traditional IRA. Keep it simple. Keep it simple. That's where you're at right now. But otherwise, I want you talking to your accountant. If it's not me, if it's me, definitely talk to me. If it's not me and you want it to be me, definitely check us out at megkwheeler.com/tax. But have that conversation, because they can look at the whole picture and figure out what makes the most sense for you. Okay, I want to make sure I answer I haven't seen questions a little bit. I don't know if that's because I've killed everyone with boredom and no one is actually awake anymore for this, or if it just makes so much sense that people are good, or if everyone just is sort of like, oh, that was a lot and I'm going to figure it out another day. But I want to make sure questions get answered. So I'm going to give it a couple of minutes and just make sure, because I do still see people here live. So I want to make sure everyone is covered. And I also will remind everyone that we have, hold on, and Anne, I see your question. I'll pop it up in 1 second. So next week, we have our money meeting next Wednesday, November 10th at 2 p.m. Eastern, a money meeting session on Zoom. Just a reminder about that. Okay, so Anne says, general retirement math question. I've heard that you need to contribute 15% of your income for your entire career, mid-20s to mid-60s, to have that same income in retirement. Is that true? Well, okay, is that true? So it's not, here's my problem with things like that, is it's a broad stroke, right? Is it true? Maybe, probably. It's not a bad place to start, but the problem there, it's failing to take into consideration a couple of things. Number one, what your retirement looks like. Are you retiring at 60 or 80? Are you retiring and traveling the world? Are you retiring in a paid-off house with very little, debt or no debt and very, very few bills? What does that retirement look like for you? That is a huge differential for people, because people have wildly different retirement scenarios. And that right there is the first question you have to answer. What do I want my retirement to look like? What about medical stuff, right? What is your access to, if you've got folks who work for the government or whatever, maybe have, my mom's a teacher. She's got access to, medical for the rest of her life. through her teacher pension. So if you've got something like that, then maybe you're saving less because you're not as worried about needing funds to cover the stuff that Medicare doesn't. So that's that first piece that this question, or this statement, I should say, doesn't really dive into. The second piece is, how are you investing your money? So if I put 15% of my income into a very conservative, bonds and mutual funds and, what else is conservative? I don't know. And it's making maybe 5%, then I probably need to put 15% plus in to get the returns I want in my retirement. If I'm a little more aggressive with my investing, especially when I'm younger, I've got more time to recoup it. If I'm putting stuff in real estate and over here, maybe I'm getting 7%, 10% on average every year. And so now I don't need to put as much money in. So, again, it's how are you, what's your risk level, right? Where are you putting your money? What are you doing with it? So I think those two factors are really crucial in thinking through and avoiding a blanket statement like this. And again, I would direct you, I can help on the tax side of things, right? But I would direct you to any one of these retirement calculators to just get a sense of first and foremost, what does your retirement look like? What do you want it to look like? And what is that going to cost? And then second of all, go to one of these calculators and say, okay, if I need X, what do I need to have in there every single month or every single year to get that amount? So that's what I would recommend to you. But I don't like blanket statements like this because I feel like they totally miss all of these factors that just, that really make a difference. They really make a difference, right? So, so that's my final answer on that one. All right, what else? Any other questions? Any other questions for folks? I'm going to give it another few seconds because I know sometimes it takes a little bit. I'm losing my voice now. I've been talking about retirement for too long. This is why I like to do more workshop style so I don't have to talk the whole time. But that did not happen in this case. So let's see. I'm just making sure I got everybody else on here. Okay. All right. I'm going to leave it there then. I don't see any other questions. As a reminder, next week, money meeting session. And don't forget, we're still doing a Q&A every month here. So our Q&A, you can obviously bring your questions to money meetings. I don't want to imply that you can't bring them to money meetings because you definitely can. But if you've got questions on this stuff or anything else, we're doing our Q&A on Thursday, November 18th at 2 p.m. Eastern. Bring them there as well, or post them in the group. I'm happy to dive into the group. The retirement stuff tends to be a little more complicated. That's probably better for me doing a video. But if you've got a question, feel free to put it in the Facebook group. Anne says she's doing a spreadsheet now. She can email it to me. I love it. I'm super excited. Anne makes the best spreadsheets, hands down. She is incredibly well organized on this stuff. So I'm excited to see this. I'm going to leave it there, folks. Again, let me know if everyone has questions. And I think that's all we got. So hopefully that wasn't too painful. I will actually tell you one thing before I go. December is going to be a little bit different. So for our monthly December workshop, instead of doing just like a 1 hour on a particular topic, we're going to be doing our year-end planning workshop. We're going to be talking about retirement. We're going to have some stuff there for it. We're going to be talking about budgeting and setting financial goals for the new year. So lots of good stuff. That is going to be December 1st at 2 p.m. Eastern, but it's going to be 2 hours. So 2 p.m. to 4 p.m. Eastern. We will send you an email on it. You get access to it. If you see promo stuff around, you can ignore it. You get access to it. But I think it's going to be a really good time. So I will see you all next week for our money meeting. Hope you all have a great week. Talk to you soon.